Welcome to another issue of the Grey Market Talk on the Tactical Brief with former market maker Thorsten Wegener and extraordinary Chief Investment Officer, Manager, Bond Trader, and golfer, Nic I. We have our little show on again for you today. I have only two topics today on the docket. First of all, hello, Nic. Thank you for your time.
Good morning.
The two big things I want to talk about was the Treasury death spiral and equity markets valuations. And Nic will also slip some easy to explain bond math for all you guys, because then you hear it from the, how do you say, the horse's mouth, not from the equity boy. And I will pump up my beautiful chart deck. Let's see whether I get that. Nic, you tell me when you see it on the screen.
Yes.
Lovely. So the Grey Market Talk for the 15th of October. And as I already said, we want to talk about the Treasury death spiral because we also need clickbait names for our little show. By the way, subscribe, like, and share. I've seen all our competitors do that right at the beginning, Nic. So maybe we make a mistake that we wait till people watch it and ask at the end. So we're slipping it in right here now. And I have to start with something I came across this week. I reposted it also on LinkedIn. Because the first thought when I saw this slide, you actually see a basket for everybody who's just listening, a basket of chicken McNuggets. And the headline says, local man paralyzed after eating 413 chicken McNuggets. And before I read further, my first thought was, okay, I'm 412 brief. Ja, ich bin 412 brief. And then I thought, yep, and read it. So the limit is 412, it says underneath. And thought, yeah, I still have it. That's how I would make a market. And obviously I had to repost it on LinkedIn, which I usually don't do. But hey, it is what it is. Treasury death spiral. Let's spend some more, I've called the subheadline. And the slide here, Nic, I found very interesting. We see the US government debt daily. And if you look at the chart, you see one straight line. It sees actually the US government debt growing, yeah, nicely from bottom left to top right, and then we have the debt ceiling period where it does nothing, and then we have it increasing again at an annualized of 27%. Does that make any sense for you, Nic? Is that sustainable what we're seeing here?
Well, it's really frightening. I mean, we've talked. This is now episode 24, by the way, and I think since episode 1, we've talked about. This has really been the elephant in the room for all markets to consider, because this will drive what's going on in the long term for the market. It's not just the borrowing, it's who's going to, finance all of this stuff. Is it going to be the Fed coming in? Is it going to be retail coming in, institutions coming in, crowding out the, the economy? It's a really big problem. And this is why I think I've mentioned it. You forced me to say it once about, this time it's different. It really is different because the level of sovereign debt really around the world, but you can see in particular, because they're much more transparent about it, what's going on in America. This is the major problem. And I think this is the driver of policy for the next years.
So I have another slide coming for that. Let's first go through this one because it simply shows the S&P earnings yield versus 6 months Treasury bills. Yeah? And what we are seeing here is obviously one of the main drivers. We could have that later in the equity valuation part as well. Where I'm positioned at the moment is say, yeah, I have my money in US dollars short term and wait till things happen. And that's what we can see here in front of us. S&P earnings yield is below what 6 months Treasury bills are offering you at the moment. And they're being produced like hot cake at the moment. And the main question we have all the time, who is buying all that crap coming out there? And who will buy it in the future? If you say that's the policy we are going to see for the next 12, 24 months or whatever it takes to have the next president sworn in, whoever that might be, either a lip or, by the way, Kennedy running for president as an independent. What do you make out of that, Nic?
Well, obviously the Democrats didn't want him, and I think bad luck for them because he comes across very sensibly.
If he runs as an independent, that he's also snagging a lot of votes from the anti-Trumpers in the conservative.
I think he will take votes from other people because he is he has sensible ideas about many things.
Yeah. No, he feels like a former Democrat, not like a new Democrat, but like an old-fashioned, call it the good Democrats who were not blinded by virtue signaling, but bring things to the point and want to change things for the man on the street.
Yeah, I think, as I say, I think he comes across very well. His ideas and thoughts about all issues are sensible, pragmatic, and not based on, feeding either some industry segment or some weird ideology. And for that reason, I think he'll get a lot of the sensible votes. But looking at the polls, I haven't looked at the polls recently, but when I did look at the polls and when he was there, he's a good voice, but he's still a long way away from being likely to be somebody in contention.
Yeah, that was a slip. He's a good voice. Yeah. Well, I have always thought a guy with that voice can never win an election. Have you ever heard him? It's like somebody.
Yes, absolutely. I mean, I get that, and I think that's everybody's criticism of him. Yeah. But you know what? I think the person with the best voice, and the person who came across extremely well in recent history was Obama. But he let people down. Fantastic voice, very eloquent. Could charm everybody with his words. But I think a lot of people were left wanting after his presidency. So having a good voice isn't really the answer.
Starting with your base case or my base case that we have some time before the next election comes in, and whoever wins it, Republicans or Democrats, nobody ever stops spending. It's just how excessive their spending will be in the future. A bit less excessive or more excessive, but they always find a reason to spend more. And on this chart, we can see actually, which is quite interesting, the black line going down. Excuse me, still the cold. It's showing. Is showing who is actually buying all these treasuries out there. And the households I found very interesting. It's the blue line here. Have actually picked up the bag when the foreigners stopped buying or even unwinding their treasury positions. The Federal Reserve was unwinding their positions. Insurance and pension funds are doing what they're always doing. They have to invest in treasury bonds. It's the rules, it's the law, that's what they got to do. But the question I was asking myself, if the households are coming in, Joe Blocks on the street doing all these investments, there is the narrative, the retailer never wins, Nic. Is the retailer at the moment filling up on treasuries and getting hosed? Well, they're not getting hosted, they're mostly going into short-term bonds, but they're not getting it right. At least that's what the saying on the street is.
I don't usually like what I hear from the street, but the reality is, right? So what's the important thing about all of this is the money's going somewhere. Where is the money coming from households? If it's just coming from a bank deposit and going into treasuries, the real question, or into money market funds, the real question is that impeding growth? Because banks, of course, with their deposits, they multiply that through fractional banking. Money market funds don't. So the question is, if you take money from, one part of the economy to feed the government, are you preventing money going into the economy? And are you harming growth? And that's the most important thing. Is the Treasury crowding out growth for the economy, and ultimately we know that there is no way that the Treasury can continue on its path without some kind of support from the Federal Reserve. And in fact, the Congressional Budget Office already assumed that from, I think it is 2025 or 2026, that the Federal Reserve's holdings of treasuries will start to grow again. And this is, the government saying we expect the central bank to be, a major buyer of treasuries going forward, because, if it's coming from somewhere else, then, this will squeeze growth. Yeah. And we talked about, I think it was last week or the week before, where I said, you've got a bank saying, well, I'm sorry, I can't lend you money because I've got to go and buy some bonds. And that's the reality, is that if you force people to prevent, risk capital, if you like, going into the economy, then, you're going to kill the economy, and nobody wants that. So, irrespective of what the Federal Reserve talk about, reducing their balance sheet, I think that's a pipe dream in such a scenario. And, that purple line that you've got, which is going down, quantitative tightening, will eventually pause and probably find its way going back up.
So in itself, it could be the harbinger of doom for the next banking crisis, not for the big boys out there, but for the guys. We discussed that also on the show, obviously, where investors are not giving their bank deposits, or the man on the street is not giving their bank deposits to the banks, which they can multiply through fractional reserve banking or supply loans in the local industry, but they're now sitting in treasury bills.
And that's right. And that's what this whole crowding out argument is. And obviously, there's a region, you have a regional bank. So the reason you have a regional bank is to support the regional economy. And if the regional banks are very vulnerable now to money piling out of their bank into money market funds, or the regional bank is going to have to jack up its interest rates, very high level. It's going to have to pass on much more of that cost to people who want to borrow. But, the reality is that it kills their margins. And the question is whether or not they can survive. And this may or may not be wanted by, the powers that be in the States. Maybe they think they've got too many banks. And that's why you hear the likes of Jamie Dimon saying 10-year yields, 7%. And rubbing his hands, because he knows he's going to ship in a lot of these regional banks fairly cheaply.
Yeah, well, it's one of the points where I thought recently about where Mr. Marx, old communist Marx, might have been right about his drive of in a capitalist society. You inevitably see this thrive through concentration. Yeah? So the spread between the regional banks and the small banks and the big boys out there, the JPs, the Goldmans, the Wells Fargos, the Citi of this world will widen, because customers sniff out, yes, if I want to have saved money, I can have it there. And the business model for smaller banks is pretty much out of the window. I don't know in how many years now no new bank in the US was founded.
I don't know that answer either, but, JP Morgan had their results this week, and, bumper and record and all of this stuff. And as I say, politicians are not sort of blind to stuff like this, where they say, well, hang on a minute, we raised interest rates to, dampen demand so that perhaps the inflation will come down a little bit. People are struggling in the street to pay their mortgage. And then there we have the richest bank in America, with the richest CEO in America, basically making the most out of this thing. As I say, this is not something blind to the politicians. And we saw that from the Italian government when they had this, this tax, this, sort of suddenly if there's money coming into a certain sector of the economy in a time of crisis, that the government will soon take that away from you. And that may well happen in the future. So, let's not get too bold about some of these earnings numbers from these institutions. The government will find their way to take it, depending on who's in government, of course.
Let me ask you a question, because you mentioned JP Morgan, and I'm thinking fondly of them because they were the ones who sacked me after they took over Bear Stearns. So I was a JP employee in good standing for 6 months till I got the shaft. Anyway, because that was the question I was wondering. In equities, they did not so good, but they had a bumper year on the bond side. How the fuck did they manage that in a bond market crash? I'm pretty sure they weren't just, let's be bond shorts till kingdom comes. If you're one of the biggest asset gatherers out there, is it just booking shenanigans? Did they book all their bonds into, fine to maturity and realize profits on the hedges they had on, or am I getting that completely wrong? Because I could not understand that.
Okay, that's a good question, and for somebody who's not so close to their P&L and their capital charges. So the whole idea of holding assets to, in this sort of hold to maturity bucket, is that P&L swings or sort of mark-to-market movements in the underlying don't actually hit your profit and loss account. So, but they do hit your capital account. So you don't see it when they report earnings per se, but you do see it when you look at their capital account. And if their capital account has been reduced in that time, where you know that that's their mark-to-market loss. And the question is, it could well be. I honestly don't know, because I'm really not an expert, and it's wrong for me to speculate. But you could imagine a bank would, with holdings in their treasury portfolio, knowing in their hold-to-maturity portfolio, knowing what they've got, that they just simply say, well, obviously we want to, take some risk off in an environment where our CEO expects 7% yields. So we're going to hedge ourselves. And then there's a lot of profits building up from just their hedging through their profit and loss account, whereas the losses are taken into their capital account. But I'm not an expert on JP. I don't analyze JP. I've got no idea what's going on within their things, but you can imagine that such things are taking place. So unless you can truly analyze where does their profit come from, we are just speculating, but that's my guess.
Yeah, no, I'm with you. It just reminded me of the good old days when I started on the floor at the stock exchange, when the old senior traders, when they bought a huge position, and it went against them, that disappeared into the banking books, where it simply was valued till the end of time at the price they purchased it from. As long as you had liquidity, everything was fine. Things have changed, obviously, in the meantime, but if you are a giant like JP Morgan, you are by definition your bonds long all over the place. Yeah, they soaked into your balance sheet. They must be in every corner of the house. And in a bond market crash like that, you're making money on the bond side. It's always, makes me curious where that's coming from. And if you're systemically relevant like JP Morgan, I'm pretty sure you can do whatever you want to like.
You can, and let's not forget that during the crisis in particular that impacted Silicon Valley and the others, who was the beneficiary of all of the money that was coming out of the accounts, the sort of flight to safety that stayed in the banking system, went to JP Morgan. JP Morgan don't need to pay 5% for deposits like a regional bank, or 4% or 3%. So they've been getting away with paying for 1% whilst they're lending the money out, thanks to Jay Powell, their friend, lending the money out very expensively to corporates, to individuals, to everybody. So they are one of the few institutions in America that are truly able to take the spread, not pay depositors, the Fed are putting at a short-term rate. So paying depositors 1% or whatever that is, and lending the money out really expensively. So JP is an exception and not the rule.
Yeah, well, it's a nice business if you can have it. Yeah, if you're
absolutely,
if you're really rich, you get even more rich.
The world favors the economy that we've got favors the large organizations, and you can look at that in any way you want when you look at what's happening with the S&P 500. And you've shown me charts on this in the past, I'm sure, where you say, well, look, if it wasn't for the 7 fan mag, whatever it's called, then we would be flat for the year, or plus 2% for the year. And that's the reality, is that the flow of funds that go into equities go into large institutions just by virtue of the fact that they're large. So, the bigger you are, the more money you get, and the richer you become.
Well, that's definitely one of the trade ideas. If one wants to elaborate on that, the spread between regionals and the big banks, I think it's something worth looking. Let me come to the next slide, because that is how I chose the title for today, the death spiral. It's a projection. How much in the different yield to maturities the Treasury will have to issue compared from 2013 up till 2024 to be expected across the yield curve. And where's the death spiral part coming in? Obviously, how does this enormous debt has to be financed? Well, through new issuance. What are the new issuance doing? Well, they're going to depress the prices. You will have to pay all these newly, let's call it income generated, and perpetuate this death spiral, which makes me on the other side almost interested, because if these extremely sensible cases are being made that the worst is yet to come, and you see huge volume after you had a correction of 40-50%, that's usually the end of a crash, not the beginning of a crash. Getting it wrong, Nic?
Well, I mean, this, as I say, this has been a topic that we've discussed since the very beginning. The maturity profile of the US government is unlike the corporate profile or the mortgage profile of US borrowers. So the people who have been harmed most by the rise in interest rates, so corporates have benefited the most, right? Retail have benefited the most. The people who have paid the most or will pay the most is the US government, because they're the biggest borrower, and they have the maturity profile very short dated, which means that in the next 2 years, something like 12, 13 trillion have to be refinanced. I mean, imagine that over the next couple of years, 12 to 13 trillion have to be refinanced by the US government in a very short space of time at interest rates which are eye-watering for that amount of borrowing. And that just increases the level of the debt. It's increased $1 trillion, I think, since we started talking. And since the interest rates have gone up, that will put the interest cost per year for the government, something like over 1 trillion per year. Now, imagine that is larger than the money that they spend on defense. And yet the people who are arguing in the House and the senators about all of, where should the money go? Well, they've got 1 trillion of something which is just being paid, which nobody is currently discussing, which I'm pretty sure that people will start to ask the question, why on earth is our budget, which is 2 trillion a year in deficit, suddenly increased by another 1 trillion a year purely because of interest? What is going on? And it will end in tears. And, this is the whole idea about how do you position for something like this and how this is the big story. I mean, everybody gets caught up with these Twitter things of end of the earth on, oh, look at the valuation here and look at that there. The big story is, what does this sort of debt problem lead to? And it leads, in my view, to a devaluation of the currency against stuff. So in the end, if you are borrowing so much money as a sovereign, your currency will go down, not necessarily against the euro or the Chinese currency or the Japanese currency, not necessarily, but against other stuff. So the other stuff being perhaps commodities, gold, Bitcoin, oil, all of these things. And that's the kind of the driver behind what's going on with the BRICS. The people who used to finance the US government's debts are now saying, what's the point? Well, we want to put our money into some other safe haven for us. So this is the real issue for, that I think, as an investor, you need to think about how to position your portfolio.
So the Fed is actually really between a rock and an extremely hard place. On the one side, inflation is not really disappearing. Well, you can reduce everything to the core, super core rate, where they strip out everything you need to make a living. Yeah, fine. Then you could pretend that inflation is going down. In reality, we all know it's different. I just paid on Thursday in a German supermarket 10 euros for 1 kilogram of minced meat. I remember when I grew up, that was poor people's food. My mom sent me to the supermarket to buy it for 3 to 4 Deutschmarks a kilo. So food inflation is there to stay, because we're doing everything wrong. So the Fed is now here, sees that as well. The refinancing demand of the government they have here, that they actually have to refinance to pay their debt burden. out of it, and they didn't do where I lost the bet against you, to increase their interest rate by 25 basis points the last time. And the market is expecting, because, well, higher for longer, for them now at their next meeting to slip in another 25 basis points at the top. To think, in my head, is the Fed is now standing there. They will lose credibility if they're not increasing rates. So they should have done it when I said to do it. So they have to do something about it. On the other hand, they are now squeezing the Treasury to say, hey, what we're going to do. So when is this going to break? Either the market will lose trust in the Fed, if they still have it, or the Fed will strangle the market to a degree that there's actually not possible to run a civilized sovereign anymore.
So, you asked me a long time ago, why is there no recession and all of this stuff? When the government are have a deficit of 2 trillion a year, this is stimulating the economy. And if you then add on top another, well, let's just say for the near-term period, another 500 billion of interest costs, and let's just say it's something like 35% of that interest cost goes overseas, so 65% of that 500 billion will go into the US economy. That's also stimulating. So this is money that is helping, putting money into people's pocket, avoiding more recession, avoiding problems. But actually, who is it putting money into? It's again putting it into those people who can actually afford to invest and save. So this is, the reality is that the more they do this, as long as the system continues to believe that the US government debt is not a problem, because it is still the currency of choice for the world, it's the reserve currency, then as long as everybody, and whenever I brought this up, by the way, to top economists, they all just, they poo-poo that. They say the US can do what it wants. Nobody will stop them. Well, there will come a time, but in the meantime, we don't need to see kind of death and destruction, we don't need to see the death spiral. What we will see is, in parallel, other things start to increase in value relative to treasuries, relative to the dollar. And those other things will be, in my view, commodities, Bitcoin, gold, oil. Those things will start to increase. And that will be the sign, if you like, where people are just saying, oh, I've got it now. Now I realize, how do I properly defend my portfolio against an inflation, which is going to happen because, the Fed they have to debase. They have to print. Somebody has to print to pay for all of this stuff. The only way to protect my portfolio is to increase investments in gold, in energy, in oil, in real stuff, because that will become a problem going forward.
So the recent spike in oil and gold, are we making that according to the situation we see in the Middle East at the moment, or is that already one of the first signs?
Look, if the thing with the Middle East didn't take place, and gold was where it was, and oil was where it was, I'd say, yeah, that makes sense. So we talked about gold, and I said there was a risk of gold touching the 1700s, got to 1810. I actually looked at this chart, did a chart with my own kind of analysis, and it formed a good correction. It's bounced beyond a level where you'd say that correction continues to go down. So, for me, gold is back up. Gold is now bullish. Gold is now, but it would have done that without what's going on in the Middle East, in my view. So it's very easy to put narratives of why things happen, but I think forget the why, just look at the price action, and that tells you everything.
No, with gold and oil, I'm actually also inclined to wait another 2 weeks, because if history tells you anything, whenever Israel is defending itself, they do it properly, they do it hard, they do it brutal, and after 2 weeks, everybody is crying for a ceasefire because they are so mean. Yeah, the usual thing, the bully attacks you, you defend yourself against the bully, and then the bully turns around and says, oh, you're hitting me too hard, you can't do that anymore. And in all the history scenarios, about 2 weeks is the window for Israel now to sort out the situation, at least a little bit. And then the ceasefire will be on the cards. Everybody will banging on against Israel again. Oh, you're too brutal, blah, 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 the usual bullshit. And I think then we have to revisit gold and the energy situation where that comes in. Anyway, completely different topic. Didn't want to talk about that anyway.
These are short-term impacts. I don't think people are ready to say that there would be a long-term impact. So, I remember doing a talk when there were attacks on, I think, 5% of the global oil supply. And I think I gave this talk in 2019. You were there. And I said, doesn't matter. Oil will fall because the chart is it will fall, right? And these short-term impacts are not something that you should focus on and extrapolate forever and make anything other than a short-term trade on. If the general trend of oil prices are that they should be going up, then oil would be going up with or without all of this stuff, in my view.
Let me slip to something more boring. I don't call it boring, but I slipped in the word duration a couple of times in our show now, especially when we talked about the TLT. And again, was a nice sheet published on LinkedIn. By the way, I want to say that. Thank you very much to everybody who posts that stuff on LinkedIn. I'm not citing the sources here all the time, but everything you see here on the screen, I've reposted. So connect to me on LinkedIn and go into my profile. You see the guys who are posting this stuff, which I'm very grateful for. And what we have in front of us is now simply a little bit of bond math, treasury duration, convexity, and asymmetry. Nic, what is duration in a bond?
So when you buy a bond, you get a coupon. So if in the good old days, if you'd have bought a bond and it had a 2% coupon, you would have paid, let's say, 100 for it and would have got a very fine 2% coupon. And as interest rates started to go up, the bond prices would fall. And the duration is just simply a measure of just how much the bond price would fall for a certain percentage of a rise in the interest rate.
Is that the so-called incremental, the incremental move everybody is explaining? So if interest rates go up by 10 basis points or down by 10 basis points, then the bond duration would give you the equivalent of how much the price of the corresponding bond would go up or down.
Correct. And that's exactly right. So you've got on the first line here, bond duration 1.9. And that just simply means, the price of the bond would fall by 1.9 versus, I don't know what versus a 1 basis point move in interest rates. So if you wanted to be sort of, super cool, you'd say, well, I think interest rates, I bought this bond at 2%. Interest rates, I think, will go up quite a bit. Therefore, my risk on the bond is, let's just say, I thought interest rates will go up by 300 basis points, 3%, 300 basis points. And therefore, I can just do a simple calculation and say 300 basis points times 1.9, and that tells me how much my bond price would fall.
So it's in my world, it's the delta we're talking about.
Correct. In your world, it's the delta.
Excellent. So let's complicate it now, because that's obviously not all of it. And that is the point that actually got me quite excited about bringing that into the conversation. It's the term you guys call convexity. And what you can see at the moment is actually very interesting. It's in the green box, the gentleman who published this, is convexity in terms of if the market, the interest rates go up or down by 50 basis points in either direction. That is not what the duration tells us will happen, because we are talking about a bigger magnitude here, which will show a different increase-decrease profile or chance risk profile. So maybe you can elaborate on that, Nic.
Yeah, so in my silly example where I said, 300 basis points times 1.9, that should tell me the answer. And of course, it doesn't tell you the answer. And the reason is because there is this added complication. The duration will give you the answer for very small changes in interest rates, as you've said. But once the interest rate moves are much wider, suddenly you've got to bring in another calculation. And that's what this thing called convexity is all about, which basically says that, and this is a good thing about bonds, this basically says that actually the bond price will not fall in a straight line. And I think that's what your red line is here in the middle segment. The red line depicts what the straight line estimate of your duration calculation would be. And at small changes in interest rates, that's true. So I guess if you were here at 100 on the vertical column with 4.5 or whatever it is, 5% in the bottom axis, you're at that point. That red line and that curved line are very, very close. But the moment you have a wider differential, a wider change in interest rates, the convexity protects you from falling along that red line. So if you follow that red line basically says if interest rates move from, let's just say, the 5%, and then you go down to the right towards 8%, then the bond price looks like on this chart to be falling to a price of 50. But actually, because of the convexity of the bond, or the convexity properties of these fixed income instruments, you actually follow the blue line. And the blue line, therefore, gives you a benefit. It basically says that the bond price won't fall as much if interest rates go down. And then on the other side of the argument, if interest rates fall, the bond price will actually increase at a faster pace than that straight line would have assumed by the duration.
So let me run that by you in the green box in an example whether I got that right. So in the middle, you see the full bond math in the green box, and it says, if I'm bullish on bonds and I want to go long bonds and interest rates increase by another 50 basis points, let's take the 20-year Treasury bond, I will lose 0.9% on the bond. However, if interest rates fall by 50 basis points, the base case scenario I'm making at the moment that it eventually will have to happen because there is the huge recession or depression coming in there, you'll make 11.8% on the upside, even though the move is 50 basis points in each direction. In my mind, that sounds like if I'm buying a bond because I have that base case that interest rates will go down, it's a free gamma. I don't have to pay it. When I buy an option, I have to pay for my gamma. If I buy a bond and have this scenario that interest rates will come down, this convexity works in my favor. I can make more money if my case is correct and lose far less when my case is wrong, right?
That's right. So
Excellent.
There you go. That's a pretty, and that's quite an important thing. So if you have a look here, 12-month total return, let's look at the 10-year Treasury. 10-year Treasury, it says current rate 4.6. Bond duration 8.1. You go across into that green box. I haven't really studied this box, but I'm kind of feeling my way in as I'm talking here. But if it says, if you look at third column down, it says if there's a 50 basis point rise, my 12-month total return on the bond, which should fall in price as interest rates go up, is still positive by 1%. And it's still positive because the bond falls in price, right? But you're also getting 4.6% as a coupon.
Correct.
And if you look at the box below, simple calculation, no convexity. If the bond if the yields fall, you make 8%, 8.3%. And if you go to the box in the middle, it says, you would have made 8.2%, without the convexity. But if you just sort of go across to the 150 basis point fall, you make 16.3% with convexity or 15.3% without convexity. That's basically how to read this chart, I guess.
Yeah, no, perfect. Because that is actually, we were talking about the TLT, and a couple of my guys are actually quite bullish. Not for long, but they've started building up positions, and I actually like the profile we see in here. Yeah, if you get it right, you'll make more than if you get it wrong. The kind of trades you like to do. And let's face it, if I do it on the option side for this beautiful feature of the gamma, I always have to pay a time premium here. Yes, you could argue you also have a time premium in bonds, but I think that makes a lovely defensive trade with a good chance risk profile, where the total returns of the bond will not completely screw you up. You still have your money preserved in the example you just gave. Lovely. Thank you very much for that, Nick. So then let's go to what everybody's waiting for, at least I am, the equity valuations. And, oh yeah, wait a second here. I've called it Let the Algos Rule, and that's a little Easter egg at the end we'll have in there. Birkenstock, I mentioned that before, yeah. They now went public, and Birkenstock is what German tourists wear in the summer with sandals, socks, sandals. You identify a German in the past, very popular, and they went into the high price segment, and they from Birkenstock went to a Birken flop. Yeah, they went public last week, and they were immediately slaughtered. Why I'm mentioning that was the hope I expressed. The less popular the lefty foot gear becomes, the more hope there is for us that the spook is over and that we are getting sensible in markets and economies again. Anyway, I have the business cycle model, the simple quad model again on the screen. If I look at it, Nick, where are we at the moment? Purely data driven. If I take the main increments I have here, deflation and inflation, and expanding economy versus contracting economy.
Well, the last time we looked at this was only a few weeks ago, I think. We basically said we are in a mild expansion. So it does depend on where you are versus the center point. So I mean, people should go and look at your business cycle video, but that was all in German. For the English speakers, look at the video from a few weeks ago. I think you've got a picture of this with our face in front of it. Inflation is measured on the horizontal axis, and growth is measured on the vertical axis. And the quad 2 box, as you've called it, expansion, is a situation where inflation is on a rate of change basis increasing and growth is increasing. And the box on the left of that, the recovery, is basically a situation where the rate of change of inflation is going down. So it is going down, but there is still growth in the economy. So we are still around that center point. We're not hugely expanding, we're not hugely deflating, not hugely inflating. So we are somewhere very, very close to this center point in the box. And the last time we spoke, the inflation numbers were increasing. So we're on the right-hand side of it, but only marginally. We may well have peaked, so we may well be entering this sort of what you call the recovery quad 1, what other people call a Goldilocks world, where you've got low inflation and slow growth, which is kind of an ideal scenario. And we are getting close to that because, growth in America is 2.1. The Fed have been theoretically excited because that's higher than trend growth. Trend growth is at 1.8. So we are there or thereabouts at trend for the American growth. We're not collapsing in our growth. Or the growth numbers are not collapsing in the States. They are in Europe, right? So Europe is a different kettle of fish because Europe have this situation of contraction and deflation, if you like. So in theory, Europe is recession. And then your next question is going to be, well, why has the DAX kind of generally been going up? And
well, it isn't. Since we said we should actually do something about that, even though we don't give any recommendations, the short is coming in quite nicely, actually.
Yeah, absolutely. I mean, I think, we should discuss valuations, as we brought up the discussion, the chart you had previously. So this is good, but you had another chart with earnings yield and earlier on, I think T-bills and earnings yield or something.
Trended policy rates versus S&P 500 PE, which shows actually, well, a contradiction, what we can see here as well. Or you mean you're talking about
the very first, yes, that one.
Yeah.
Right. So this is, okay, obviously, this is another one of these classic misleading charts because, what does that mean? It means, look, guys, what the hell are you doing buying stocks? Because surely your yield is lower than what you get in T-bills, so go and buy T-bills, and that should be the kind of the investment of a lifetime. It may well be if there is something going on, but it doesn't sort of explain anything about valuations and total returns and why people will still invest in equity markets. And I think, obviously, I think you teach this in your classes, but obviously it's about, for example, the earnings expectations of companies in America. So all the numbers are transparent in America. We use that as a guide. So the earnings this year is something like plus 1%, very low number. Okay, so the doomsters said last year earnings are going to be negative. Well, it looks like they will be positive this year, but very tiny. But the growth in earnings is expected to be at 12% next year and the year after that. So doing simple, equity valuation, there are many ways you could value equities. But if you just do a simple, next year it's 12%, year after that is 12%, year after that is, let's just say, it grows at the rate of the risk-free rate. So let's just say that's 4%. So you're going to have 12%, 12%, and 4%. You can compute based on, how much dividends they're paying, what the equity valuation would be in 5 years' time. You discount that number back to today. So what level should you discount that number back to today? Well, you could say, well, interest rates today are 4.5%, so let's discount it by 4.5%. So you think, well, but actually, no, they're not risk-free. So let's add a risk premium to the discount factor. And the risk premium is called the equity risk premium. How much does an investor require above the risk-free rate to invest in equities? So that's historically been in a range of between 4% and 6%. And there might be reasons why you'd want closer to 4 than closer to 6. And now might be a time where you want closer to 4 than closer to 6, purely and simply because you have this massive debt burden in the States. You say, well, people should be buying other stuff and other stuff should become more expensive to bonds. You discount that number back, you've got a sort of valuation of the P&L of the S&P, which is higher than where it is today. If you use a different discount factor and say, no, I want 6% equity risk premium, then you get to a valuation which is below 4,000 for the S&P. So valuation-wise really does depend on how much more risk you think equities are versus fixed income. And if you think equity earnings are going to grow, you're more likely to want to invest in equities. If you think equities are going to be becoming more rare because there are stock buybacks continually, so the volume of stocks being issued is much lower. And, your Birkenstock was a classic example. The risk capital that's in the market today, venture capital, new issues, IPOs, they're all failing. It shows you that people are still cautious. So you're not seeing the supply of equities in the market, right? So people are just not issuing. It's just like new houses. People don't want to sell their houses. People don't want to sell their shares. Or at least there's no money to come in to buy those shares. It's all about risk capital versus expectation of returns over and above the risk-free rate. And I think, we're fairly valued, but more likely to head towards 5,000 than being overvalued and heading below 4,000. That's my view.
Oh, excellent. That actually, I have this chart on, I'm using it's from Schiller. It's the expansion of the PE versus interest rates on here. Yes, we are relatively high valued at the moment. There was another chart I wanted to show. It's this one, again on LinkedIn, S&P 500 versus Bank of America Corporate Total Return Index, which shows us again, we are at levels of, well, the internet bubble in 2000. The playbook showed us we are still somewhere between reflation and the Goldilocks zone, though this is not justifying yet a crash in the markets or anything. And that's why I want to bring it in. You're more on the positive side, yeah? One of my good students who admits freely that he's not good in macroeconomics and actually doesn't put too much attention to it, but he is a veritable wizard in reading market price action and always analyzes what the algorithms are doing in the market. And he was quite ballsy. I had a conversation with him the other day, and he said, I predict before Thanksgiving that around Thanksgiving, which, let's be fair, the S&P should trade between 3,900 and 3,700, which I thought, oh yeah, that is, I won't bring it up because contrary to you, I'm more on the negative side of the market. So for the first time, he and I agree on what should happen. I think his take is very, very aggressive. Yeah, so I thought, as a gimmick at the end, I'll show a digital play with a fantastic chance reward ratio. You can have it, and I say, let's play digital and lose it all. And I'm trying to share the trading screen here, how I would set this up with a new share. You see my screen, Nick?
Absolutely.
So at the moment, we're at 4,327 in the S&P, and I thought, okay, Thanksgiving, give a couple of days, take a couple of days. I went into November 30s as maturity date, and I thought, fine, let me take these levels, 3,900. How can I, if this outlier opinion, yeah, this very aggressive, we're going to see a market in a massive decline on the short term, how would I play that nicely if I'm willing to risk a lot, not a lot of money, I'm most certainly going to lose it. I thought, let's buy a 3,900 put and let's sell a 3,895 put against it. What am I doing here? It's simply a spread I opened. Yeah, everything below 3,900, I make money, and if we drip below 3,895, so 5 points lower, I'm losing it again. However, this costs me out of this profile only 20 bucks if I open it. If I'm right at expiration, it brings me 480 bucks, which is a nice payout ratio if you can get it. What most likely happens is there is, where's the theoretical valuation? You see this line. That always stays at the center point of the spread I've opened. Yeah, it will only twist and turn around it. So you still have a payout ratio if we reach this level of 3,900, even tomorrow, of 164, 8 to 1 in this trade. So if we are expiring, obviously here somewhere, you'll make a bloody fortune out of this trade. What's the logic behind his assumption? That the algorithms which are trading our markets at the moment have switched from being bullish to being bearish. And that will, well, guide the markets on the short term. And as I said, I don't think that this huge drop before Thanksgiving is a great probability. We discussed Darius Dale's take on the party is always the best just before the cops arrive. And if I look at the fundamentals, we are still between Goldilocks and reflation. So there could be another leg up. However, in a case that I'm completely wrong with that, a 20 to 1 trade, I think, is worth putting in your portfolio with a little bit of money. And I thought I just show that at the end as a little Easter egg, and we can come back to that at least after Thanksgiving, Nick.
I think that's a really good thing, and it just goes to show. And in terms of signals and the like, and obviously I do my own signals. My long-term signals are bearish on both Nasdaq and S&P. Short-term signals turned. the only way that these signals go back to bullish is if we go above 4,500 or 4,470, I think it is. So we are in that sort of potentially still bearish mode for, algorithms, and I have my own. But irrespective of your view, and if, I'm sort of saying that, we're likely to carry on, irrespective of your view, I actually believe I love these relatively low priced insurance policies because they belong in your portfolio, because your view is just a view. You could be wrong, and you need to get some protection. If there's always an opportunity to look for something which will give you protection, it almost gives you more confidence to hold on to positions, because you know that you've got something to cover you. Whereas if you're nervous and you get out the market, you say, okay, I'd rather do nothing. You don't earn anything. So, this is an ideal opportunity if you've got something. I love these sort of...
No, correct. I wrote an article about that with an old strategy. I mentioned it even on air. The old Dutchies 25 years ago came in and said, okay, if we are in this fundamental regime, I want high beta. Can I have high beta outright? Nah, not really. There are too much red flags already in the market. But in case I'm wrong, I want to hold high beta, and I put some very cheap insurance in, which will, cover my ass and make up for my losses massively. So I have the perfect portfolio mix. And the math is actually not very, very difficult. Well, you have a 20-to-1 payout ratio.
Sure.
So nice insurance if you can get it for these levels. That's why I like the spread. The digital, we are now at around 19 in the VIX, not at the levels where you could get it really cheap, these insurances. But hey, it still is. And we started the show with, it is what it is, to quote Shakespeare here. Nic, do you have any last words after I showed this tremendous, fascinating opinion of one of my best students?
I think the trade idea is fantastic. So
thank you very much. Thank you for watching, and I hope I'll see you next week again, when we can see what has happened in the markets and what new deliberations come on. And my recommendation, have a closer look at the bond math again. That is something you should have on the radar, especially if you're interested in setting up bot trades, because you have this built-in convexity protection at the moment, if your idea is to play the market from the long side. Thank you very much. Thank you very much, Nic. My pleasure again to spend my Sunday morning with you, and have a good week.
You too.